All right, class, let's get into this. Let's get into lesson 3. I'm gonna change this to lesson 3 because it's a little different. Taxes. I know everything. It's everything you wanted to ever talk about with taxes. Let's get into taxes. Important. Page 55, actually, page 75, page 57 in an old book. There's a second paragraph at the bottom of the period, bottom of the page. This is on the PFIN textbook. The overriding, I'm gonna read it right out of text, ready? The overriding objective of tax planning is to maximize the amount of money you can keep by legally minimizing the amount of taxes you pay. As long as it's done honestly and within the tax code, there is nothing unethical or illegal about trying to minimize your tax bill. Yeah, so that's it. So once, I'll read that again. The overriding objective of tax planning is to maximize the amount of money you can keep by legally minimizing the amount of taxes you pay. As long as it's done honestly and within the tax code, there is nothing unethical or illegal about trying to minimize your tax bill. So I think if you read between the lines there is definitely some gamesmanship to taxes, paying your taxes. Now, if you have just a regular job, like an hourly job or salary job, their taxes are taken out, but there are a lot of opportunities for you for different types of write-offs and everything. If you have your own business, there's definitely a lot of opportunities for write-offs. I kind of lived that world for a long time. So once again, there is some kind of gamesmanship with your taxes and how you file your taxes. And then this is on the, actually this will be page 58 of the PFIN book. This is the progressive tax structure. So this is basically how your taxes work. So when some people think, my God, this is federal, for example, that the federal taxes, this is so much what you would pay, to the federal government. Somebody says, oh yeah, you're gonna get paid, the highest federal tax rate is 39.5%. That it's 39.5% from the first dollar you make. No, it's not. It's 39.5% for anything over $413,200. I don't think President Biden has put his new tax plan in place. If you're watching this recording at a later date for another class, these things can all change. But for the most part, this is how they work. That from $1 to $9,225, those dollars will be taxed at a 10% rate. Right? From $9,226 to $37,450, those dollars will be taxed at a 15% rate. So that doesn't mean that everything from $1 to $37,450 will be taxed at 15%. It's just everything within that I guess you can say, I'm gonna do a slideshow. Everything in that tranche, I guess you can call it, it's kind of a financial term, will be taxed at that 15% rate. And then $37,451 to $90,750 will be taxed at a 25% rate, and so on. So it's not everything over $413,000, or everything before 413 is taxed at 39.5%. It's everything over that is taxed at 39.5%. But everything below that are taxed at different rates. There's different filing statuses that you can do as well. There's single. Single is basically if you're unmarried, legally separated by divorce or separation. There's married, filing jointly. These are married couples who combine. That's the most common. Married couples who combine their income and allowable deductions as one. So basically you take all of your money, you lump it in, and it's just in one. Essentially, you take money from two pots and you put it into one pot. And that's basically what you are telling the IRS, how much income you have, how much money you have. There's married filing separately. This is kind of get tricky. If we were in person, we kind of have a little lively, robust conversation about this. Why do you think some people would do, if you're married, you would file separately? Some of the reasons are one person could be self-employed and they could put a ton of write-offs. And if you don't know what write-offs are, we'll get into that a little bit. Think about write-offs as essentially like a coupon that you use. Let's say you made $100,000 in income. If you go here, oh sorry, $100,000. So roughly the top tax rate would be 28%, um, and also, can you work your way up to that 28%? Let's just say, just for simplicity here, you made $100,000 and you get paid, you get taxed the 28% bracket. So you paid $28,000 in taxes. That's not the actual number, but just for simplicity's sake here. So you have to pay, taxes on, or so your take home is 72,000. You have to pay out 28. But then somebody else in your family was self-employed, and they had their own business, and they could basically put, okay, maybe I'll put my health insurance over here. I'll pay for that. Some of my mileage, some of my other expenses, they can add up on their side. So that will kind of essentially lower their tax liabilities, or their tax burdens. It's kind of just very tricky with how you can do these things. But it's generally when one person has a traditional job where they get their taxes taken out in a check, another person might have they might be self-employed. And then the self-employed person, you have more ability to have more write-offs. And what I started saying with the write-offs would be, it's kind of like a coupon at the end of the year. It's like, okay, when you do your taxes, here's how much I owe, but here's a little coupon that I have of expenses that I have that I can legally write off, that I can say, instead of owing $28,000 in taxes, I have my own business and I can go take people out for entertainment expenses. I use 7% of my gross income for that. So I can say, okay, every time I went to a sporting event or out to dinner, I can take $7,000 of that. So 7% of 100,000. So instead of owing 28,000, now I kind of use that write-off coupon in a sense, and now I only owe 21,000. Okay. Oh, but then I have my car. My car's a lease, and you own your own business, and your lease payment is $400 a month. So now you say $400 a month times 12. What is that? That's what $4,800 $4,800 for the year. So now, instead of owing initially, you owe $28,000. You take off the 7%. So now of the entertainment. So now you owe 21,000. Now you take off another 4,800. So now your tax, what you owe is even lower. That's kind of using the tax code and the laws presented to you. That's exactly out of what that first thing I said was. The overriding objective of tax plan is to maximize the amount of money you can keep by legally minimizing the amount of taxes you pay. And that's the, Congress makes the tax laws, for our benefit. Head of household filing is unmarried and pays more than half of the cost of the upkeep for a household with an eligible dependent, child, or relative. That's just it's a tax filing. So let's say you're not married, but then you have children. You have could have adult children living at your house, but you pay most of the upkeep for the household. I'll take that back. No, you're not married, but you have children who are not eligible to pay taxes on to pay taxes themselves. So that's a head of household filing. Then this is interesting. When qualifying widow or widower of a dependent, a person whose spouse died within 2 years and the tax year and supports a dependent child, may use the joint return tax rates, is eligible for the highest standard deduction. So within 2 years of your spouse passing away, you can still take advantage of these married filed filing jointly statuses, which you pay less when you're married. And here's what it comes down to. There's a lot of benefits, to being married. Hopefully that you're married to the right person. But financial benefits, there's tax advantages. When you have children, there's also tax advantages, so you can write more off. We'll get into insurance. When you're married or divorced, you usually get lower insurance rates. So and it's for the insurance purposes, they see you as being more responsible. I'm sure we all know people who are married are completely irresponsible. It's not accurate, but that's just kind of what it comes down to. Take-home pay. So your federal withholding taxes. So when you do your taxes and you do your filings and you get your job and you give your social security number and you do those things. Okay, how many people are you claiming, that kind of stuff? That just all triggers your take-home pay and your federal withholding taxes. These are taxes based on your earnings combined with your withholding allowances claimed. Okay, the more holding allowances that you claim, then the higher your check's going to be. You can't keep doing that. But I used to work at a job, and if you had a really low check, if you had a commission based, and your check was going to be lower, then you would just claim a lot, so that your check will be higher. But then that'll come back to bite you in the butt if you do that every time, because you would end up owing at the end of the year. FICA, you see this probably on your checks a lot. Oh, okay, let's go back a little bit here. So you see this, the highest rate here is 39.5%. State of California, the highest rate is 12.3%. So let's say you're making over $400,000 and you would, or $413,000, you're going to pay 39.5%. That's going to be that max that you're going to pay. And then on top of that, in California, there's a 12.3% California state income tax. Some states do not have income tax. Texas, Florida. That's why some people go to want to move to the states, because you will just pay the federal tax, not a state income tax. The states will run on, but it's probably thinking like, what's the purpose of tax? The purpose of taxes is so that we have the infrastructure here. So we have roads, we have bridges, we have clean air, we have electricity, we have working street lights, all that kind of stuff. We have schools, all that kind of stuff. For other states that do not have that, they get that money out of sales tax. They get that money, or they get that money from the federal government. So there's a lot of different ways to do that. That FICA, that's a big one that you see on your for your taxes, and that money is basically put in it's taxes for your Social Security. So once you hit, and we'll get into Social Security later, what those ages are that you can start collecting on your Social Security. And Social Security just came about after the Great Depression. President Roosevelt, or Roosevelt, as my grandmother would say, enacted the Social Security Act, because there are many people who are older who did not have any savings. So as you work your way, through your career and through your life, a certain amount of your check is saved or put on hold for you, put in a separate account, so that when you do retire and you stop working, you can have some income coming in. It's not going to be a ton. It's not going to be a lot, but it's something that you have. That's kind of the beginning of it's called a social safety net. And social safety net is so that once you're at a certain age, you will have some type of security. Now let's get into three kinds of taxable income. There's active. That is income earned from your job, your wages, salaries, bonus, tips, pensions, alimonies. We'll get into pensions later in the class. Alimony is, if you're divorced and your spouse has to pay you alimony. So this is active income. This is income that is coming in every month actively. So that's the first type of taxable income. Second type of taxable income is portfolio income, which is earnings generated from investments, which is let's say you have your stocks, you have your bond, all that kind of stuff. You have your real estate that you might sell. That could be that's also considered portfolio income. So money that you're earning from investments, and that'll be done at a capital gains rate. And we'll get into capital gains, I think, in this slideshow. But capital gains is basically I think it's currently 20%. It might be raised under some presidents want to have 0. Some will have 20%. So basically anything that you have, any investments that you do make, you have to pay taxes on the profits, right? And when you take that money out. Passive income, which is real estate, rental income, and partnership. So let's say you own your own house, and then you have another house that you own, but you get rental income from it. That's called passive income, and you do have to pay taxes on that. Here's capital gains right here. Capital gains. A capital asset is sold for more than you purchased it for. You bought a house for $500,000, and then you end up selling it for $1 million. You made $500,000, so you'll have to pay the capital gains tax on that. There are certain carve outs and certain exceptions. If you reinvest that, you have a certain amount of you can kind of do that. I want to say if you do it once every 3 years, you can keep doing that, so you can kind of get away from paying some of the capital gains tax. But or if you're a big trader, if you make all of your money essentially in the stock market, that's why there's a lot of pushback, politically, when you see somebody who is working at you know, at Subway or working at, you know, Target, and they pay a certain tax rate. And then you have somebody who's not doing who could essentially be retired, but they have all their investments, which are generating a ton of money for them, but they're paying at a much lower tax rate than the people who are out actively working. Now, is there good with this? Is there bad with this? Yeah, there could be bad with this. You could be, let's say you're paying at a if it's 0%, that's, you know, then there's some people who are, you know, getting wealthy off of this. If it's a 20%, yes, you might be paying 20% on capital gains, which might be a lower rate from somebody else. But if you're making, you know what, $1 million in investments and you're paying $200,000 in taxes, yeah, it's at a lower rate, but the net contribution is going to be a lot more than somebody who's paying at a higher rate at a lower paying job. So I definitely see both sides of it. So adjustments to your gross income. This is in just allowable deductions. Once again, deductions, essentially think about deductions, write-offs. Deductions and write-offs are the same thing that you can just basically use as a coupon at the end. Like, you know, when you go to a restaurant or something and you have a coupon, your total for your bill is, you know, is $50, and you say, here's my 20% off coupon. Now you take $10 off. That's essentially what deductions and write-offs are. It's a coupon that basically you can show the IRS and the government that that you have, so you don't have to pay as much in taxes. So adjustments to your gross income, allowable deductions you can take off your pre-tax total. Examples: education expenses, you can deduct that. IRA, we'll get into IRAs; those are individual retirement accounts later. Self-employment taxes, which is SEPTI IRAs as well. Self-employed health insurance, which we get that in subsequent classes, and then alimony as well. Standard versus itemized deductions. This is in the old textbook, pages 62 to 63. But I think it's 63. So some standard deductions are, just the standard deductions would be your filing status, like you're single, married, filing jointly, and so on. Those are your more or less your standard deductions. Your itemized deductions could be something like medical and dental expenses, state, local, foreign income taxes, mortgage interest payments, charitable contributions. That's an itemized. So if you can making charitable contributions, if you lost money because of an accident, kind of casualty losses from like a disaster, that's another. Moving expenses are not deductible. So, but there are different itemized deductions that you can do. So standard is just with your filing status, which would be like these: single, married, jointly. Those are standard deductions, right? Head of household, qualifying widow, all that kind of stuff. Your itemized would be special deductions: medical, dental expenses, mortgage interest, and there are some other opportunities as well. Tax credits, they're big. It's the amount you can take off the bottom or the back end of your taxes, more kind of coupon related things. You get automatically $1,000 tax credit per child. Or when you adopt somebody, when you adopt a child, hopefully you can only adopt a child, you can't adopt an adult. $13,400 adoption credit for that 1 year. Why do you think it costs that? You get that huge tax credit? Because there's a lot of expenses that go along with adopting a child. Solar. I don't know if we're still in. I think you still get some tax. No, I think those expired. But when you do solar, and same with Tesla or electric cars, you would get these tax credits as a ways to incentivize you to make purchases that were for the greater good. Estimated taxes. Oh, okay. That's if you don't receive a traditional paycheck with federal withholding taxes taken out, you can make estimated tax payments April 15th, June 15th, September 15th, January 15th. If you have ever hear anybody who's self-employed and they say, I have to pay my quarterlies, this is what it is. So you basically will pay a quarterly estimation on how much that you would pay. A common amount is usually like it depends on what you want to do, but it's not uncommon to pay quarterly like $800, or you can pay as much as you want. I think $800 is just kind of might even be the minimum for some cases, or just kind of you go under the radar. So let's say you are you're self-employed and you do your quarterly taxes. That means on April 15th, June 15th, September 15th, and January 15th, you would pay a certain amount, and then that you deduct that from what you would owe. So let's say you're making quarterlies. I'm just going to throw out a number here. Your quarterlies are $2,000. You're just paying $2,000 a month, and you make $100,000, right? And then of the $100,000, you're going to have to you're getting taxed at the 28%. So you're gonna have to pay taxes on $72,000, right? Or you know that your take home is gonna be $72,000. So you have 28 going out, but you already paid $2,000 4 times. So you've paid $8,000. So now instead of only $28,000, you owe $20,000. That's kind of how the estimated quarterlies work. April 15th, that's your usual filing date for the previous year's tax. It got all screwed up, everything BOC because of COVID. Extensions can be given, but they should be filed by April 15th. Extension deadline is generally October 15th. There's I want to say there's like a June or July extension, and then there's also an October extension as well. Amend returns. You can amend or alter your tax returns if there is an error by you, accountant, up to 3 years after filing your taxes, after tax filing. You can do that. So you can say, hey, listen, I made an error, or you changed accountants, or your accountant was not in the know with a new tax law and they screwed up. You can go back 3 years and amend those taxes. And basically, it's kind of like, hey, let's try again, kind of a thing with your taxes. So you can do that. You can go back 3 years and amend your taxes or alter your taxes, and essentially refile. Audited returns. This is IRS will randomly select tax returns and wants to make sure it was done correctly. Less than 1% of returns are audited, and the IRS cannot ask for audit filings dating back to 7 years. My old CPA, he would always say every time that he filed taxes for all of his clients, he was always just like, man, I thought, okay, I'm 7. That just means that whatever happened 7 years ago with the client, don't have to worry about it, kind of thing. So, and some really good CPAs, what they'll do is they just want to make sure that you fly under the radar from the IRS, and it's not uncommon for that. So it's very rare that they do that. And generally, what will happen? I've known some people who've been audited, and they will just like say you're self-employed and you have your they will take all of your, you have to provide them with all your records, and it's better to provide them with a ton of records than nothing. I've known people who have actually just gone into the IRS or audit with just boxes and boxes and boxes of stuff and just say, all right, here you go, figure it out. It's better to do that than to have nothing. But they will say, okay, let's look at you wrote off a lot of mileage driving. And then they'll basically go into, let's just look at that category. And then they'll go through it. And if it looks good, for the most part, like, all right, that's good. This is consistent. This looks good. And that shows a pattern that the rest of your taxes probably look good. Thanks for coming in. Thanks for playing the feud. Here's your home version of the game. And then you're on your way. That's it. Or if they do see an error, then they will kind of dig deeper into it and dig deeper into the other categories to see, okay, if there's an error, there's something that's a little kind of shady, then in this category, then there's probably going to be errors in other categories. And if there's those errors equal less money than the people should have paid in taxes. So they'll get you for what you owe, and then there's probably some penalties on top of that. And then these are the commonly accepted forms to fill out. There's a 1040 form, 1040 easy form. 1040 form, when I was a kid growing up, or not a kid, but I was a teenager, I had jobs, you go to the post office and get the 1040 form and just fill it out and you send it in, and that was it. And then now there's 1040 easy forms, which are done all online. Tax evasion. Oh, this is the good stuff here. Tax evasion. That is illegally, this is bad. Now, there's two things here: tax evasion and tax avoidance. One is good, one is bad. Tax evasion is the illegal act of failing to accurately report income or deductions or failing to pay taxes altogether. That's bad. But we all go through our bad periods. I went through periods. I didn't file for a couple of years. I was just in a little lull. My career was, I was having some issues with my jobs and my career, and didn't. But then then you get back on track and you do it, and then you get back to the top of the mountain. We're all going to fall down. So the tax evasion is the illegal act of failing to accurately report. So basically, you did not file your taxes at all, or you were dishonest on your taxes. That's bad. You can get in trouble for that. Tax avoidance is completely legal. That goes back to that first thing that I read you of, where is it? The overriding objective of a tax plan is to maximize the amount of money you can keep by legally minimizing the amount of taxes you pay. As long as it's done honestly and within the tax code, there is nothing unethical or illegal about trying to maximize your tax bill. This is tax avoidance, completely legal. Using the existing tax laws to your benefit, using the gamesmanship of the tax laws to your benefit, and potentially using a good CPA to your benefit too. Just ways to creatively reduce taxes that are legal and within the laws and the intent of Congress. The laws are there for a purpose, is to, and why would the government want to do that? Because in theory, what would happen is that if you pay less taxes, yes, there's less money going to help roads, bridges, infrastructure, education, all that kind of stuff. But what are you going to do with that money? Are you going to, you might invest that money, which when you're investing money, you're making companies and corporations stronger. Or are you just going to go out and you're going to spend money? You're going to, and that basically makes the economy stronger as well by just being, a consumer. Tax-free income, very few examples, municipal bonds. We'll get into that later, and then a Roth IRA, which we'll get into the Roth IRAs later, but there's very few tax-free options. There's tax-deferred income, which you can be immediately tax-free. You can get some money, or you can have some income with tax-free at the time, but eventually the taxes will be due on that. That's it. All right, class, that was good. If you have any questions, you know how to find me. Take care. Bye.